Okay, so good morning, everyone. I'm gonna start talking about the new chapter. Actually made a change. I initially had chapter 8 on your revised schedule, but I'm going to jump straight to chapter 13. Actually, I think 13 includes chapter 8 topic, and also it goes into more detail regarding the flow through entity, which we're going to be looking at in chapter 14. So 13 and 14 sort of match better together than chapter 8. So the first thing that I wanted to provide was an overview of income and losses, the character of these, and we have like three different buckets. The first bucket is the ordinary, so we could have ordinary income or ordinary losses. Uh, uh, Ordinary income could be from salaries and wages, it could be from our self-employment income, it could be from a flow-through entity, and I'll explain a little bit more about the flow-through entity. And then also from property disposition, as we looked at in the previous chapter. And then we also have another bucket for investment or portfolio income. So we have our interest, we have our dividends, we have qualified dividends, long-term, short-term capital gain. We know that qualified dividends and long-term capital gain are taxed at preferential tax rates. And also, as we looked at in the previous chapter, our property disposition, anything in excess of the depreciation recovery, then it will be taxed as a long-term capital gain, or Section 1231 gain, depending on how long we held the asset and any other particulars that we looked at before. So for passive, the third bucket, which will be kind of new to you, is the passive income and losses. So we can have passive income and losses from most of the time rental activity. So in general, rental activity is considered to be passive. And except for a real estate professional, we're going to look into that later. And then flow through entities, especially from like a limited partnership or a limited LLC that's taxed as a flow through entity, then we are going to have some limitations in terms of losses. The next one, overview, it relates to flow-through entities, and I'll explain a little bit what exactly is a flow-through entity. So let me just jump ahead to the next slide. An example of a flow-through entity is, for example, a partnership or an S corporation. Let's say, for example, that the partnership has a net profit of 100,000 for the year, the tax year, and we have two partners who have a 50-50 share in the partnership. So what this means is that instead of the partnership paying the tax on the 100,000 and then having that income distributed to the partners, and then the partners subsequently being taxed on that same income, which is the double taxation, which we're going to be looking at in chapter 15 for the corporation. The partnership does not pay taxes on the 100,000. The income is reported separately to each partner based on their profit and loss share, and then each partner is responsible for paying their taxes. So in that respect, let me just grab my pen really quick. In that respect, each partner is going to be taxed the same or differently depending on what their marginal tax brackets are on that income. However, that doesn't mean that the partnership doesn't file any tax return. The partnership will file a Form 1065, and then each partner, respective partner, will file a Form 1040. They'll report their flow through income, which they will receive is Schedule K1 from the partnership, and this is Schedule K1 is reported on Schedule E, page 2. So you may want to kind of, Google these forms, go to the IRS website, Google Form 1065. You can see how it looks at the partnership level. And then you can also check the Schedule E, page 2. So Schedule E, page 1 is used to report the rental activity. And then Schedule E, page 2 is for flow-through entities. So going back to if we have a loss from this flow-through entity, it may be limited. So there's basically 3 levels of limitations. The first one will be the basis. So we have to calculate the basis that the partner or S corporation shareholder have in this entity. Depending on their basis, then they'll be able to deduct the loss. If they pass the basis, then we move on to at risk. So basically, the at risk is very similar calculation to basis. And at risk determines exactly what are you going to lose from this transaction, from this company that you contributed your funds to. So let's assume that I a limited partner in a partnership, and I have contributed $10,000 to this partnership. So all I have to lose so far in this partnership is just the $10,000 that I contributed. So my losses will be limited to that 10 grand. I cannot deduct an additional loss that will exceed that $10,000. So just in a nutshell, that's the at-risk. We're going to be discussing that in more detail in just a few minutes. And then the third level we have, so if the loss, we have sufficient basis and we have sufficient at-risk basis, then we have the passive consideration. So if I have a passive loss, even though I have sufficient basis to deduct that loss, passive losses are limited to passive income. And most rental activities, although it's not a flow-through entity, but most rental activities are considered passive. And so their losses from rental activity will be limited to passive income. There are some exceptions to that. We're going to look into that in a few minutes. So from flow-through entities, this passive losses will be only offset against passive income from other activities. Passive losses can carry over just like capital losses. Okay, so we're getting into at-risk rules. At-risk is basically, as I just explained, no, this is the amount of my contribution that I have put into this business, and I'm at risk of losing that contribution or what we have accumulated from our business. So we're going to go into more detail exactly what increases and decreases at risk. You can look at this in your textbook also, table 13-1. We have cash contributions, property contributions, our share of liabilities. We'll go into liability shortly. Income items, gains, which are going to be separately stated on the Schedule K1. Again, I recommend that you take a look at the Schedule K1 for Form 1065. And then things that are going to decrease my at-risk basis will be cash distributions, property distributions, and release of liabilities. And so this will determine the amount that is at risk. And from this amount that is at risk, then I can determine how much of losses I'm able to deduct in the current year. So we have an example here. In 2018, Zeke contributed land with an adjusted basis of $15,000 and a fair market value of $30,000 to the partnership. In return, he received a 5% limited partnership interest. You have an example of Zeke's Schedule K1 in the textbook. So what we're going to determine here is how much can Zeke deduct in the current year from the losses that were generated from the partnership. So the partnership, his share of partnership losses is $7,000. So how much of the $7,000 he's able to deduct? Now, note here that we're giving him credit only for the adjusted basis of the property that he contributed. We are not giving him credit for the fair market value. So just keep that in mind, that when a partner contributes property, we are going to give them credit. Most of the time, we're looking at adjusted basis. Interest income, this is what was reported on his Schedule K1. So this is his share of the interest income, his share of dividend income, his share of capital gain. Now, if you notice, these items are separately stated on the Schedule K1 for the purpose that these items fall into different buckets. So the interest income and dividend income and capital gain are portfolio income, or in other words, investment income. Capital gain, we have to make a determination if it's short-term or long-term when preparing Zeke's income tax return. But we're not going into that right now. We're calculating the at-risk basis. And so his total basis is $16,423. The loss, his share of the loss in this partnership is $7,000. So he has sufficient positive basis here to deduct the $7,000 and leaves him with a balance of $9,423 carry over to the following year. So in 2019, Zeke, let's assume, had a loss of $11,500 from the partnership and had no other increases or decreases to his at-risk basis. And so since his at-risk basis carryover is only $9,423, he can only deduct out of this $11,500 the, oops, I went too far there, the $9,423. So the remainder, the difference between the 11,000 and the 9,423, or 2,077, will carry over to the following year. Okay, so at-risk rules. The at-risk is reported in Form 6198. We don't have to worry about preparing this form at this stage. We also need to look at liabilities. So we mentioned that their share of partners, the partner's share of their liability will increase at risk. The release of the liability would decrease the at-risk basis. So exactly what liabilities are we concerned? Not all liabilities are measured in the same way or considered the same way. We have recourse debt. So that means that recourse debt, the partner is personally liable for that debt. So they either guarantee the debt, or they took so they actually carry personal. So if the partnership were to default on that debt, then the partner will be responsible for paying the debt. And so this will increase the at-risk basis for the partner. Non-recourse debt, that means that none of the partners, or this particular partner, does not personally liable for the debt, so it's not going to increase at risk. And then qualified non-recourse debt relates to real property, and then this will increase the at risk. So like we said, the losses that are disallowed because of the at-risk rules are carried over indefinitely and deducted in years when we have a positive at-risk amount. Okay, some questions here. Which of the following items will increase a taxpayer's at-risk amount? Probably all of them. Which of the following types of liabilities does not increase a taxpayer's at risk in an activity? And that will be the non-recourse debt. Okay, I'm just gonna move along. Okay, so we have what is a passive activity. So we said the first step was to calculate the basis, then the at-risk basis, and then passive. What is passive and what will be those limitations? So what exactly do we mean by passive? That means that the taxpayer does not materially participate. And this usually could be translated to the partner, or it could also apply for rental property. That person has to actively participate, and that means more than 500 hours in the business. But in general, most rental activities and limited partnerships are considered passive. So here we have a little bit more of the 7 tests to determine material participation. Okay, so like we said, passive losses are allowed out to the passive income. We already talked about the 3 categories of income at the beginning of the presentation, so you may want to go back to that. Pretty much the same. Active meaning ordinary, portfolio income, and then our passive income. So here's an example of how these passive income and losses come into play. We have Edna, a taxpayer who has she's a partner in 3 separate partnerships. Partnership A generated a $10,000 income. That's actually her share of the partnerships A income. And then partnership B and C, her share are losses of $8,000 and $6,000 respectively. And so we can see that we have 14,000 of losses, and we are only able to deduct up to the income of 10,000. So that means we're going to have an excess of loss that will not be able to deduct in the current year, but it will carry over indefinitely, hoping that we have income from the other partnerships to offset it. So as we said, rental activities are usually considered passive unless we're a real estate professional, so that will be an exemption. You can read over the 6 requirements for non-passive for rental, but for our purposes, we're just going to assume that rental activities are passive. Even though rental activities are passive, there is an allowance of $25,000 loss for taxpayers that have AGI of $100,000 or less. And they have to own at least 10% of the property. So 2 examples here. We have a taxpayer who has AGI of $85,000. She has a rental activity and it generated a $12,000 loss. Since her AGI is less than $100,000, she can deduct up to $25,000 of rental. loss. In this case, her $12,000 rental loss is fully allowed or fully deductible in the current year. So she doesn't have to have passive income to wait to offset the $12,000 loss. In this next example, let's assume same facts except that her AGI is now 140,000. So it has exceeded the 100,000 threshold. That means that we're going to have to limit her loss to actually only 5,000. So the 140 minus 100,000, the threshold, times 50%. This is how much we're going to reduce the $25,000 allowable rental loss, or maximum allowable rental loss. So we only have 5,000. So out of the 12,000 rental loss that she realized from her rental activity, she can only deduct $5,000. And the remainder will carry over to the following year. Once, if we have, let's say, these passive losses trapped, we were never able to deduct it, or we did not have sufficient passive income to deduct these trapped losses. When we dispose of the activity, whether that's a flow through interest from a flow through entity or a rental activity, we are allowed to release all these losses and deduct it in the year of the disposal. So example here, Jamal sells his entire interest in a rental property at a gain of $15,525. He generated a loss in the current year, or this activity generated a loss of $2,800. He had 12,650 trapped passive losses that he was not able to deduct in previous years. And so in essence, this 15,440, this is what these two add up to be, will be offset against the gain of 15,525. It's just where it's reported is in different forms. So the gain will be reported on form 4797, as we observed from previous chapter on property dispositions. And the current year loss from the rental activity and the passive losses carryover will be on Schedule E and Form 8582. So in the end, when he looks at his Form 1040, then in essence, only he'll be taxed on a net gain of $75 because we were able to offset these losses that were trapped against our gain from the disposal. Okay, for number one, I will say is true. The general rule concerning the deductibility of passive losses is that they can be deducted only to, that's true. Okay, and you can go through these and test your knowledge. As we said, we have the order that needs to be observed in calculating the allowable loss. Okay, this is a good example. We said that, for rental losses from rental activities, we have a maximum of 25,000 that we are able to deduct, but that 25,000 starts to phase out or be limited for any excess over 100,000 of AGI to be completely phased out by 150,000 of AGI. So in this case, we have a loss of 23,000 from rental activity, and the taxpayer has an AGI of 105. So that means that we're going to have to take 105 minus the 100,000 times 50%, right? So 105 minus 100,000 times 50% is 2,500. So we have to reduce the 25,000 maximum allowable loss by the 2,500. So only up to 22,500 is the amount that the taxpayer is able to deduct in the current year. Since their loss was 23,000, then the $500 that was not able to deduct in the current year will carry over. Okay, so that's pretty much it for chapter 13.